everyone. I'm David Darst, here to give you a recap of the month of January 2025. There were a lot of very interesting and market-moving developments in the month, starting with the inauguration of the President of the United States, and he issued quite a large number of executive orders relating to border security, defense, social policies, international agreements. Would remind everyone, in his first term, started in January 2017, he issued in his 4 years a total of 220 executive orders, of which 72 were canceled or rescinded, either by him or by his successor, President Biden. We had also inflation numbers. The core CPI came in at 3.2% for December. That compared to 3.3% in November. That's the consumer price index. The producer price index, 3.3% for the month of December versus 3.5% for the month of November. Importantly, the Michigan Consumer Sentiment Survey of expectations, they survey a broad number of consumers. 1 year expectations of inflation, 3.3% for January versus 2.8% in December. So you can see inflation seems to have stalled out here. 5 to 10 year outlook by this consumer survey, 3.2% in January versus 3.0% in December. So again, inflation expectations up. On January 21st, you had the announcement of the Stargate initiative, a $500 billion proposal to invest heavily in artificial intelligence infrastructure. Shortly thereafter, you had the announcement of DeepSeek, which is a Chinese initiative by an entrepreneur there. According to him and the news flow, a much cheaper artificial intelligence model with reasoning capabilities similar to OpenAI. This caused a 17% drop in NVIDIA. It did recover 9% the next day. Then it came down 4 or 5% the day after that. So there's been a lot of a commotion and activity in this space. There's many more rivals expected now to enter this space. So this bears watching, because it's been one of the 4 pillars. Inflation coming down, the Fed cutting interest rates, economic growth being satisfactory and solid, and of course this promise and potential and enthusiasm over artificial intelligence. Very importantly, not to miss this one, Scott Bessent has been confirmed as Treasury Secretary by a vote of 68 to 29. I think 18 Democrats joined in voting for him. And he basically has a number. I think he's going to have a big influence on financial asset prices and on financial markets. He's very experienced, and he is of the opinion that long-term interest rates and the term premium, that's the extra yield that you get for owning longer maturity securities, should not be something that is hurting the financial markets and the economy. So we will see there. I would just say expect innovative actions from the Treasury Department in coming months, and we will be reporting to you on that. December jobs came out early in the month of January, 256,000 jobs, which was substantially above expectations. Unemployment, 4.1% versus 4.2% in the month of November. Average hourly earnings, 3.9%. This led Chair Powell, this is the last development, a big development of the month of January, at the January 28th, 29th FOMC meeting, the Federal Open Market Committee, basically to institute no change in the Fed funds policy rate, 4.25 to 4.50%. Chair Powell downplayed this further progress on inflation aspect, and he kind of walked back that a little bit, basically emphasizing a wait-and-see approach. And we will also be waiting and seeing. The next meeting of the Federal Open Market Committee is March 18th, 19th. Right now, Fed Fund futures markets are assessing an 84% chance of no change, no interest rate cut, and 16% chance only of odds of a 25 basis point cut. The meeting after that will be May 7th. Right now, even now, 59% chance of zero interest rate cut and 36% chance of a 25 basis point cut and actually 5% chance of a 50 basis point cut. Right now, though, it's going to be a wait and see and data dependent. Remember the three phases of this new presidential administration. Number one, the administration will be proposing many things, which it has already been doing in the news media and also with its executive actions. The second thing is Congress disposes, meaning does Congress pass these? Do they modify these plans? Or do they reject them? And those will be influencing financial asset prices, and we will keep you updated on that as well. And the third part is actually implementing, and that's where you're going to get. So as of right now, I think we're okay with a 10% gain for liquid equities this year. We will, very importantly, is the 2017 Tax Cut and Jobs Act. Will this be extended? How long will it take to pass this? So that's, I think, going to be a major influence on financial asset prices. In terms of positioning, we continue to recommend having some liquidity that you can use opportunistically should there be a sell-off in financial assets. In public equities, we recommend diversification by style. I think you're going to see a broadening out in the equity markets in the U.S. This year. So you're going to go into smaller and mid-cap stocks. You're going to go into value stocks, and you're going to be reducing a little bit. We still like and have some recommendation in the tech sector, but specialize in artificial intelligence beneficiaries. What companies can integrate this and make money out of it? That's the key. And some defensive sectors as a form of hedge. In private equity, there you want to allocate capital across strategies such as buyout, such as growth equity, such as secondaries, which we've talked about in the past. You want to allocate capital across industries and across geographies and across vintage years. You want to balance risk, the liquidity constraints where you're going to have you're going to give up some liquidity in terms of a better return and the return potential. The private credit sector, there you want to basically diversify across borrower profiles, multiple industries, different credit qualities. You want exposure to different private equity managers. And you want basically focus on private equity managers in the top quartile. Syndicated loans and collateralized loan obligations are also attractive to us for structured exposure. Specific strategies within that area, direct lending, mezzanine debt, distressed debt, special situations, asset-backed lending, and a little bit in the real estate credit and infrastructure credit area. With that, we wish everyone a great continuation of 2025 and look forward to catching up with you very soon.